Hello everybody and welcome to the Cyclical Investors Club YouTube channel. Today we're going to be analyzing Synopsys stock, ticker SNPS. This one came in by request in the comment section of one of my other videos. If you have a video you would like me to analyze on the channel, just put it down in the comment section. I will get the ticker on the whiteboard behind me and eventually I will make a video. If it's a stock that's not in the S&P 500, I analyze those on Patreon and in the full Cyclical Investors Club service over on Seeking Alpha. If it's in the S&P 500, usually I post those here on the YouTube channel for free. The Patreon's $5 a month, and if you join there, you can get a big discount if you ever decide to join the full service, and those links will be down in the description. Also, you'll see me using the fast graphs here. I have a 25% off discount code or link down in the description for FastGraphs if you think it is interesting. I've been using it for quite a few years now, and it speeds up especially the initial process of going through a stock pretty quickly. All right, as always, this is not individual investing advice. This is just how I analyze stocks. So when we go back in the history of the earnings of Synopsys, I'm not sure if that's exactly how they say their name or not, but I think it sounds right. Ever since 2005, like for the last 15 years or so, earnings have basically grown every single year, and most years double digits. And they've actually been accelerating recently. So they were growing kind of teens, and then when COVID hit, they started growing in the 20% range. I would generally expect them probably to tail back toward COVID growth ranges. One thing to keep in mind with stocks is, let me see what their market cap is. Yeah, they're 85 billion, so this is not a small company. There is a limit to how long they can grow at like 20% rates. And probably we saw leading into COVID, these mid-teens earnings growth. I think that is probably the more reasonable estimate to use going forward, rather than looking at these 2020 to say 2023 when earnings growth was like 25% maybe on average. If you start using 25% growth rates and you take them out 10 years, high valuations can start to actually look pretty good. But the problem is it's very difficult to go 15 years in a row with 25% earnings growth with an $85 billion company. So for these guys, I'm using an 18% earnings growth rate expectation. That was probably an average of all these together. Kind of a mix of before and then a mix of kind of now, and then hopefully we can get somewhere in the middle without being either too optimistic or too pessimistic. So that was my thinking coming up with the earnings growth rate. I'm not sure what, let's see what FastGraphs has. If you shrink this, because otherwise it will count these extra years. If you shrink it down, it will give you the growth rate. So they have 19%. So we're for this time frame that we're looking at here. And so I'm only 1% lower than that. And it's pretty much in line with future. They're looking at 20% this year, 17% next year. So, I mean, I don't think that's too controversial of an earnings growth rate. But other than that, I mean, beautiful looking earnings chart. I mean, if you bought when it was a 15 PE back here, and when they had a slowdown of 9% earnings growth, I don't know if I'm going to be able to get this off here now. Yeah, you'd be doing extremely well right now. So let's get into the valuation metrics here a little bit. So I have my 18% earnings growth rate. The stock would look like it was trading at like a 45 PE. They don't really have any, actually they have net cash, so I gave them credit for that. So instead of a $538 price, I'm treating it like it's $527 when I get the earnings yield here. So the forward PE is about 40, and then I'll give them a little credit for that cash, and so that'll actually bring that 40 down just a little bit when I get my earnings yield here. And so I have an earnings yield of 2.54%. So the way to think about this is, if you bought Synopsys for $100, it would earn $2.54 the first year on your $100 investment. And if you own the business, you could take, I'm just doing a little math here. You could, yeah, so my PE ratio after the cash came in at 39. So it's almost the same. But if you look on Fast Graphs, it's like 45. So I'm pulling forward earnings growth, giving them credit for cash. So you can see that I'm being pretty generous in terms of the valuation, right? So yeah, if you bought the company for $100 and it would earn about $2.54 on your $100 that year, and you could take that money and go spend it. You wouldn't have to put it like back in the business or anything. That's how I treat it anyway. So what I want to know is how much this would grow if it's growing at 18% over 10 years, and how much money you would collect on your $100 over that time period. So when I do the math on that here, I get your $100 grows to $170. So if you put that in a CAGR calculator, which would be $100 growing to $170 over 10 years, you should get something close to like a 5.48% CAGR over that time. So this would be my expected return from the earnings over that time period. This is right in line with the S&P 500 right now. So the questions you have to ask then is, okay, I would pay the same right now. I'm just talking about relative returns here for a second. It would be a hold for me if I owned it. It's not below 5%, but it is on the overvalued side probably. But the way I would think about it in relative terms is, and this is what a lot of people I think have caught on to the past few years with all the tech stocks and like software stocks getting higher valuations, is, do you want to get this expected CAGR from a business that's growing, has like no debt and cash? Would you be willing to take your chance on this 18% growth rate more? And if you're wrong a little bit, have to wait a little longer to get your return back in a quality business? Or do you want to go for like one of these old stalwarts who are maybe getting a little disrupted, who are barely who instead of growing 18% are growing like 4.5% or 5% and doing everything they can to try to grow or just not to shrink? So, and then you do the math on them and it comes out to 5.48% too. And you ask yourself, okay, which one of these businesses would I rather take a chance on? And what a lot of people, especially in the past year, have said is, look, I'll take my chance on a company like this that maybe they don't grow 18%, but even if they grew 12%, you wouldn't get great returns, but you have a quality business that probably has a pretty good history in front of it, even if growth doesn't hit what it should be. And if there's a bunch of inflation, these guys probably have a lot more flexibility in terms of dealing with that as a business. So if on one end, I'm not long this stock, but I totally would be if I didn't get it at a good, I didn't quite get low enough when it was trading down a couple years ago. But I did manage to buy quite a few stocks similar. And my thinking is I would rather have on one end a stock like this, where I know they can pass inflation on, where growth might be in question in a recession, but they're pretty nimble. They can adjust pretty quickly probably, which we saw Meta do, and also Google. And if I can get that on one end, and then I can get like short-term treasuries at 5% on the other end, when you put those two together, it makes a pretty good portfolio. So that's kind of been what I've been adjusting toward the last 18 months or so. So I think a stock like this can definitely be useful depending on, if I was going to trade out like one of these old stalwart stocks for a company like this, and they basically have the same CAGR expectation, I would definitely take more of these type of companies. You don't have to go all in or all out. But, you know, I would trade, well, I'd made my Walmart video, you know, Walmart was actually a little worse than this, but you could easily trade out of Walmart into something like this, and I think that's a trade up. So even though this isn't particularly cheap, right, there could definitely be situations where it's still attractive, and I think we've really seen a lot of that with the buying. I mean, some of these valuations are a little out of control, but they're not necessarily out of control relative to like what else is out there. So yeah, it's expensive. There's definitely risk whether they can hit this growth rate for probably 10 years is a lot. But sometimes the companies like this can get a boost from unexpected things like AI or what, you know, we've seen it happen. And you never know what it's going to be in advance. You just try to get the good companies, and some of them you'll get lucky and kind of hit the jackpot. So in terms of when to buy, now during a recession, using the old recession data, you saw that the stock used to trade really pretty cheap. I mean, even not in a recession, it was trading a 15 PE with like mid-low teens growth or something like that, like a pay of 1 almost. So we know that it can trade cheaply, and that's what this buy price is based on. In this particular case, unless the whole market was really like getting creamed, the normal buy price would probably be more what I would aim for. That's like the 327. That's about 40% off where it trades right now. This would be one of those things where you want to get a good valuation, and then you just accept whenever the recession comes along, you're just going to hold through it, and you take your lumps, you know, and you just hold through it. And whenever it happens, it's probably going to hurt your returns, and you might have been able to get it at a lower price. But when you buy it, you just kind of with the understanding that it'll get through, and we are not going to, you know, worry too much about that. We'd rather do that and get a good company at a fair price than try to estimate what kind of recession drawdown you might get, which is what this is meant to do. So for me, I'd probably aim for this 327 if I was going to buy. And then if you look back, really just last year, it was down there. I mean, October 2022, I guess that wasn't last year anymore, year and a half ago, under 300 actually. Yeah, even December 2022, so just a little over a year ago, it was under that 327 mark. So I think if they had an earnings blip or the market freaks out or something, now they've been earning more money, so it would be a better valuation if it fell back. That's why I didn't buy it back then. Right? You're like, well, why didn't you buy it then? Well, earnings were, I don't know, 40% lower than they are now. So, but it definitely could, you know, if that momentum shifts or something, come down there, and then you could potentially get it at that price. So those are my thoughts on Synopsys. If you found this useful, hit the subscribe button and the like button. If you have a request, let me know. I'll get on the board. Eventually I'll make a video. I put out about a video a day, unless I have things come up where I'm not able to. And eventually we will get through all of them. I have dozens and dozens of videos on the channel already, so you can search there and maybe find one that I made in the last couple months of a stock you're interested in. Okay, thanks a lot. I'll see everybody later. Bye.